All right, guys, I'm going to make this video. This is for another trade that I am adding to ES11X Bear Trap campaign. This is May 17th expiration with 56 days to go. But before I go into the trade, I just want to show you my thought process and my strike selection, and hopefully this will make sense, right? So here I have a couple of trades that are already in May 17th expiration cycle. I believe I have 3 positions on. I have this one here. And real quick, this trade has been on for 63 days. The underlying has moved 2.25 standard deviations, and we can see this green dot here represents the day when I took the trade, which was January 19th. Ever since, we've just been in a very strong uptrend with very shallow pullbacks. I have since added another May 17 trade, which was just a few days later, I guess. Moving the bear trap a little bit closer, right? As the market was moving higher, I added another trade, moving the trap a little bit closer to where the market was at the time. And my naked puts went a little bit higher as well. And then this is the third round in the same expiration. I keep this trades separate, right, for my management purposes. But if we're looking at all these trades together as the market was moving higher, right, this is the first round, second round, third round was on February 15th. And again, my bear trap was a little bit closer. And today we are trading at 52.98 on ES. And as you can see, that my closest bear trap right now is about, let's call this about 6.5% maybe out of the money. Or we can look at the strike on the long leg of the put debit spread. This is the closest to where the market is. And that price level is 49.75. If we look at the delta is about 13. Over the next 56 days, implied probability of this 49.75 being in the money at expiration is only about, let's call this 15%. So there's about an 85% chance that this trade is only going to make the tail profit. And combine the 3 trades together, I can see that my tail profit is just shy of $1,000, which is not a terrible thing. But if there is room, and this is how I go about it, if I have room, if I have the buying power to do it, and I need to add something, I can add a position with 90 days, with 120 days, or I can see that if there is anything else I can do to any of the positions that I already have, if I can squeeze in one more with 56 DTE, such as this May 17th expiration trade, I have buying power to do it. I think that the trade I'm setting up today serves a purpose, and I'm going to show you what it looks like adding another 113, and I'm going to tell you exactly why I decided to go with a 113 instead of a 112. Hopefully this will make sense. So number one, right, by adding today's trade, my let's see, my put debit spread is now at 51.80, 51.50. So this is only 30 points wide, right? So I didn't want to pay too much for this put debit spread. So this is a 30-point wide put debit spread, which is closer to where the market is today compared to all other bear traps that I already have on. So I'm moving something closer to at the money. I'm paying a debit for it. I also wanted to keep my short naked puts as far out of the money as possible. only because, you know, just looking back to where we were about 3 months ago, right? When I started this May 17th campaign, the market was trading at around, let's call this 48.80, right? And ever since, the market has just been grinding higher with very few pullbacks down to 21 EMA. But for the most part, you can see that we held um, 8 EMA. So we're in a very strong uptrend with very shallow pullbacks. Now, I'm not saying that the market is going to crash from here, but I do think that a 5, even a 10% pullback over the next, 40 days, 50 days is not that big a deal. We can look back to, if we pulled back just 10%, we get back to 4,800 on the um, price chart. If we look at where 4,800 is, we're just about 500 points lower, but we're still way above the level where this rally started back in October of last year. So I don't think that 10% pullback is out of the money, but here, if we pull back 10%, and if I set up a regular 1-1-2 trade where I'm only selling 2 naked puts, I would have to move these puts very close, maybe down to about 4,500. And in that case, if the market does pull back 10%, these short naked puts at 4,500 are going to get into more trouble than I want them to. So that's why I wanted to keep my short naked puts as far out of the money as possible. So I needed to go with a higher number of puts at a lower price. The goal was to cover the purchase of the 5180, 5150 put debit spread and bring in about I collected $1.90. So that's about a $95 credit for one contract. So now looking at all 4 trades now, right? 56 days until expiration. This is today's bear trap that I added, which is only about 3% out of the money, which is great, right? I didn't take in a whole lot of credit, but I did add a potential of an additional about $1,500 on top of the $1,000 that I had in the tail profit. So this is somewhere between a down move of 3% to about maybe 6.5%. And we can see that right now, the delta for the 5150 is about 27. Let's call this 30 delta. So there's about a 30% chance that 5150 will be in the money at expiration, right? So we increased our odds of potentially making the bear trap at expiration. And for that, we had to put up an additional $6,500 in buying power to do it. So that's my trade here, and I hope that this makes sense, right? By itself, this trade doesn't look too appealing, right? We have this really wide trap, which is great, right? I just wanted to keep my short naked puts as far out of the money as possible. And hopefully, if we do come back, right, maybe 3, 4, 5%, which would be really, really good for the market overall, right? In order for the market to continue higher, we do need to see some sort of correction, either through price or time or both. And a 5, maybe 7% pullback over like a 2-month period is really not a bad thing. And that's what we want to see if you want to continue to lean bullish in this market. So by itself, this trade is not too appealing, but in the context of all other positions in the same expiration cycle, this is actually not a terrible way to move the traps a little bit closer and increase probability of making a nice return on margin by expiration. If we continue higher from here, I only increased my potential trap profit by about $95, and it took $6,500 to do it. So that's not too attractive, but I do think that it makes sense to add a little bit closer to where the market is right now. And I probably won't look to add to May 17th anymore. I'll just continue to focus on doing trades with a little more time until expiration. But I had the room to do it. I had the buying power to do it. I needed to put something on, and that is the trade that I chose. I hope this makes sense. This video is going to go into trade number 2846, and I will post any updates to this trade in the trade post.